Factor series continued their strong start to the year with returns in the low single digits for the entire range, against a backdrop of reasonable UK equity market returns and a weak gilt market. Year to date, which is only 2 months, remember, the funds are up between 2.5% and 4.5% net of all fees. The main story for the month was Greece's protracted negotiations and an end-of-month muddling through, which culminated in an extension to the bailout for Greece, which was due to expire on the 28th of February. Indeed, towards the end of the month, fears over a Greek exit from the Eurozone, had largely dissipated, but this was because of an 11th-hour deal agreed between the Greeks and the European institutions, as Greece submitted a somewhat vague list of reforms that it will commit to undertaking over the coming months in exchange for a 4-month extension to the programme. The dynamic since Syriza came to power has been fascinating, with early indications suggesting that the Greek public had appointed masterful negotiators to represent them at European level. The reality, however, is different, and it's interesting to note the amount of ground Syriza's had to concede to the Germans over the month. The party could well find itself coming under increasing pressure from the electorate to deliver on the heady promises they came into power on the back of. On the other hand, European politicians know how toxic a prospect Greek write-offs would be domestically in the more fiscally responsible states. The UK equity market returned 3.3%, with small cap outperforming large cap over the month. The funds have a decent weight to the UK, which aided performance, with the largest impact in the higher risk and return funds at the higher numbered end of the range. Our UK equity managers, who've had a phenomenal run of outperformance over the past year, mostly underperformed, weighing a little bit on performance. In local currency, Europe also performed well, but a large proportion of that was given back by the euro weakness against the GBP. Fixed income markets didn't perform particularly well. The gilt market was down nearly 5%, which is a reversal of January's moves largely. The funds do not have a large allocation there because we think it's expensive. Our other credit performed well, but still weighed on performance as a result of sterling's strength in the month, particularly our offshore credit exposure. For example, US high yield, global convertibles modestly negative, whereas emerging market bonds were down 2% over the month in sterling terms. So the main driver of both relative and absolute performance of the managed solutions was really the global equity market gains. We remain modestly overweight, and that will have benefited absolute and relative performance. Also, our positioning within fixed income was rewarded. We've got a low exposure to developed market sovereigns, and they were weak, especially the UK and US, which posted declines of around 4% and 2% respectively over the month. What we do hold in the fixed income market did well. Emerging market debt up around 1%, US high yield up 2 to 3%. Infrastructure securities, which are somewhere between debt and equity, and they've been strong in previous months, they're lagged in sympathy with the bond markets over this period here. Overall, our active equity managers have done well, and that's a slight reversal from recent months where we've actually struggled a bit in terms of manager selection. Overall, over this period, they've helped us in terms of our returns. There's been no major changes undertaken to the portfolios this month. We retain broad allocations to global equity with a large weight in the UK, as you'd expect, and this is augmented with exposures in Europe, Japan, as well as global mandates, and a couple of more focused strategies such as infrastructure and Copernic's Global All Cap contrarian holding, as well as the position in gold mining shares. Within the fixed income buckets, we're underweight gilts and overweight a variety of areas of the credit spectrum, such as investment grade, high yield convertibles, emerging market debt, and loans. We retain, I suppose, what is a reasonable cash balance, as it's okay value compared to government debt, and also useful to put to work as and when market opportunities present themselves. Going forwards, we expect to see a continuation of the broad themes we've seen in the markets over recent months. We still think valuations in equity markets, while through fair value, are not exceptionally expensive, particularly in a world where you've got consumers starting to wake up. You've got continued extraordinary liquidity measures being put into the markets by the European Central Bank and Japanese Bank of Japan, for example. Against that backdrop, you've got GDP just starting to improve. You've got consumption looking like it's starting to pick up a little bit, whilst on the back of a de facto tax cut, thanks to the significant fall in oil price in the second half of last year. So we're broadly constructive on the equity market. We also see a world, as the US data improves, where the chances of an interest rate increase in the US starts to become a reality. We started to see the action in the bond market on the back of that. We don't think that the interest rate is going to fly up, but we do think that on the balance of probabilities, interest rates would increase, which makes high quality sovereign bonds relatively expensive as far as we're concerned today, and as a result we try and avoid them where we can. Still good opportunity in credit markets. Spreads are reasonably tight from historical standards, not at all-time lows today, but they're not particularly exciting, but they still represent a valuation improvement over and above what we can get in government bonds. We like positions like infrastructure, like contrarian, all-cap position, and also our gold miners, which we still hold in the portfolio. We're looking for decent gains from those positions still. So going forwards, a continuation of much of the same. We expect to see more geopolitical risk, more political risk out of Europe as well. But again, a valuation-driven, well-diversified portfolio we expect to be well positioned to ride out the bumps and deliver the sort of returns our clients expect going forwards.